The belief is that the North American economy might actually fare better in 2023 than what most people anticipated midway through 2022. There is also this conversation about how the European economy, because of irrespective of what happens to the European economy, the replacement demand would ensure that the demand for trucking assets might actually not go down, if anything, may climb up. And the Indian CV story is probably a bright spark due to the infra spend expectations from the government. What does all of this hold in store for companies in the forging space? Well, let's put that question across to Mr. Lalit Kumar Khetan. He's ED and CFO of RK Forgings, joins us right now on the show. Lalit, great having you. Thanks for joining in. Hope all is well.
Yeah, good morning. Thanks,
Very
Neeraj.
good morning. The pleasure is, it's great to have you, Lalit. Can I start off with the overarching picture of what your group believes could be the outlook for 2023? The latest data that came out on Friday from the North American Classic truck sales was mixed, if you will, maybe a few bright sparks. But the belief is that the global picture will not look as bad as earlier anticipated. Do you get this sense from your customers as well?
Yeah, correct. So we are getting really very positive signals from our OEMs. And India story is certainly good, and India is going to do good in the next financial year, FY24. That's no doubt, because all positive commentary you are listening from OEMs like Tata Motor or Ashok Leyland about North America and Europe. There also we are getting quite robust demand forecast from our OEMs, and we feel overall FY24 should be a much better year than the FY23.
Wow. What could the reasons be, Lalit, for both US and EU? I mean, we've heard some reasons, but you would be in a better position to explain what's the reason for this positive commentary.
See, CV cycle is still not at its peak when it was at last peak in 2018-19. And post-COVID, it is picking up. Last year was a good year, but still there is a lot of headroom to cross the last peak. And sorry. So, what has happened if you look at the North America and Europe, the consumptions data are good, the job data are good. So, only fear is about the recession on account of inflation or interest rate hike. So these things are there, but they have taken that in their stride, and the demands are consistent. And if you look at the order backlog, even the Class 8 order backlog, that is quite good. That's almost at a 12-month order backlog. So these all give signal that the FY23-24 is going to be a very good year.
So how does this augur for a company like yours? Because you already have plants operating at fairly high capacity utilizations, if I'm not wrong. You're talking about demand looking okay from all three quarters of all three geographies, major geographies in the world for you. How does therefore the next 12 months look for you then?
Next 12 months looks very fine for us, and we are giving guidance of a 20% growth for FY24 over FY23. And the capacity, we are also adding capacity further. So capacity utilization will go up more than 90% in this quarter. So we are additional capacities will come up by September 23, and that will be sufficient for us to meet at least next 2 years demand.
So this capex, I believe 56,000 odd tons that you're adding, does that require any kind of additional fundraising or all through internal accruals?
No, everything will be done through internal accrual. No additional fundraising will be required.
Okay. So your 20% growth number that you're talking about for FY24 or FY23 would in part have some benefits of the enhanced capacity as well, which will also work out for you in FY25 or FY24?
No, part will come from the enhanced capacity also in FY24, and certainly at the full in FY25.
Okay. And you reckon that the way things are looking, demand might be enough to make your plants, even the new plant, operate at optimum capacity utilization within a few weeks' time?
Because see, after we complete this capex and have this capacity in place, we are well on road to achieve a top line of more than 5,000 crore. And our target is to achieve this 5,000 crore by FY26.
Okay. You, of course, while you're expanding capacities, you are also doing inorganic moves. Talk to us about that strategy, please.
Yeah. See, recently we have done acquisitions, or we are on the course of doing acquisition, like where JMT Auto is one of that. The COC has allotted, already ruled in our favor, and now it's gone to NCLT. once it comes to us, we will have a good sale in oil and gas segment and lot of value add. It will happen, and I hope if everything moves on time and there are no hiccups, the plant will be on stream within 1 year time, and we will be able to generate at least 200-300 crore sales in the first year, or about and 500-600 crore of sales in the second year from this plant. And it's a quite a high margin because a lot of value add is there. And it's a 30% EBITDA, minimum 30% EBITDA generating products we will be making there. So that's going to be a very good opportunity. Apart from that, we have entered into an agreement to acquire 51% stake with an EV startup. That's Suyo. And that's the conditions, decisions are being complied for by the party, and we hope to invest the amount very soon. And amount will be invested in phases, and that its intent is that with this investment in EV startup, we will be able to garner the growth or take a share of pie of the EV sector growth. And there we have a huge plan, and the way EV sector is growing, certainly we will be able to get a good share of this same.
So okay, let me first tackle Suyo, then I'll come back to JMT as well. But Suyo, firstly, the belief is that it may not be as material on the revenue front as it would be on getting you the technology to create a foot in the door in the EV ecosystem. So how do you expect your EV foray, whether via Suyo or via some other moves, to be over the course of the next 2 or 3 years?
See, there are two strategies here. See, because already what we are doing at RKFL, we are also producing the product for our OEMs for their EV modules. And there we already have a 2% of our top line in RKFL for the EV. And that next year we would like to increase it to 5% of our top line. And coming to the Suyo, they are a startup and they are doing a good in the EV technology. So they are already in motor, controller, differentials, and plan to develop gears and EXL. So we will certainly help them out in achieving that target, their targets, and help them out financially to achieve their whatever goal. And we have really a very good business plan for them, and I hope we will be able to execute that successfully.
What's the long-term strategy? Let's say 3-4 years out, what proportion of your overall revenues do you anticipate EVs to be like?
See, this revenue will be not consolidated in the RKFL in near term, and the agreement we have signed for 51% will be executed only after 3 years. So
okay.
After that, that revenue will be consolidated. Before that, the money will be invested in phases.
No, which is fine. But since it's more of a technology company, I'm just trying to understand overall, independent of this, how much do you anticipate your EV proportion to be, let's say 4 years out, 3 years out?
No, it's going to be very, very phenomenal, what we have projected. And they should be able to achieve a top line of at least 900 crore in over a course of 5 year time.
In over 5 years time. Okay. My final two questions. You spoke about achieving 5,000 crores of revenues by FY25. That's a guided number that you've anyways given earlier. What I'm wanting to know is, does this include any revenues from the JMT Auto acquisition, or is it independent of that? And JMT, if the plant comes on stream, will add whatever 300-600 crores to that 5,000 crore number.
Yeah, so everything what I have spoken is right now standalone RKFL basis. Anything coming from JMT Auto or ACIL, which the acquisition is also pending in Supreme Court, and or CO, that will be extra.
That'll be extra. And do you reckon you'll be able to achieve all of these plans while at the same time being net debt free? Part one of my question. Part two, in this heightened interest rate scenario, could the near term debt levels hurt on the interest cost front?
See, there will be little bit increase in cost of fund due to the interest rate hike. And we are not right now not looking at net debt free, rather we are looking at reducing the debt. And target is to reduce the debt at least around 150 to 200 crore per year. Okay. And improve the leverage and go to 1:1 EBITDA by FY24. And then further look to reduce, but certainly we are not going to reduce the debt at the cost of growth. So growth is paramount. And in the process, whatever debt we can reduce, we are going to reduce. And in next 2-3 year time, we are targeting to have a 0.5:1 debt to EBITDA.
So sorry, the net debt-free target conversation of FY25, FY26, does it still stand, or you were saying that?
No, I don't think with these acquisitions that net debt free will be practically, we can speak on FY25 basis. So we are looking at 0.5:1 by FY26.
Got it. But interest costs will not hurt too much if interest rates stay elevated.
No, we have kept it quite in control, and we hope that with the debt going down, it will remain in control.
Okay. Sorry, I made a mistake. My final question is actually this one. And this is my final question, which is on the expectation that the street has for the space at large for 2023 operational metrics or margins looking much better versus 2022 because of raw material input cost pressures coming off. Do you reckon the annual comparison will look much better?
See, certainly March 23 is better than March 22 because prices have stabilized a little bit. But there were a lot of input cost pressure like energy cost and other freight cost, etc. Freight cost in the overseas has gone down for the shipping cost. But overall, there were inflationary pressure on the input because commodity, yes, it has cooled down or stabilized and it will remain same. So now we need to look at the internal efficiency or optimize our cost to improve upon the margin. Certainly achieving a certain economy of scale will help. So we are hopeful for a better margin in upcoming period.
But it is not that it will be a very strong deviation from 2022.
See, 2023 already we have done well. So 23, there will be a better margin 24. Yes, maybe 100.
Yeah, what I mean is FY24, will the margins look much better than FY23?
Yes, it will be better than FY, but you significant margin, I will not say it may be 100 basis point up. That will be kind of guidance I would like to give.
Got it. Okay. Lalit, thank you so much for taking the time out and talking to us and giving us a lowdown about what's happening in that space, and all the best for the upcoming period.
Thank you. Thank you, Neeraj.
Thank you. And viewers, thanks for tuning into this conversation.